Let's take a look at calculating sales tax and purchase price. Taxation is the imposition of a mandatory levy on the citizens of a country by their government. A tax based on the retail selling or retail price of tangible personal property is also called a sales tax. This tax may also be imposed on admission charges to places of amusement, sport, and recreation, as well as on certain services. Most states and many other taxing units, such as cities, counties, and municipalities, levy or charge a tax on sales. Businesses that purchase merchandise for resale to others are normally exempt from this tax. Only final buyers pay sales tax. Many states allow a sales tax exemption for food, prescription drugs, household medicines, and other selected items. The liability for the sales tax is incurred at the time of the sale is made. Retail merchants act as agents, collecting sales taxes and periodically remitting them to the proper taxing agency. The sales tax rate is expressed as a percent and varies from state to state. When sales tax tables are not available, the percent method may be used to calculate the sales tax on an item or a service. Other non-taxable charges, such as packing, delivering, handling, and setup, are added after the sales tax has been computed. Here are the steps to calculate sales tax and total purchase price by using the percent method. Step 1. Calculate the sales tax by multiplying the selling price of the good or service by the sales tax rate, where sales tax equals selling price plus sales tax rate. Step 2. Compute the total purchase price by adding the selling price, the sales tax, and any other additional charges, where the total purchase price equals the selling price plus sales tax plus other charges. Here's an example. John Baker purchased a Craftsman lawnmower for $488.95 at a Sears store in Atlanta, Georgia. The store charges $25 for delivery and $15 for assembly. If the state sales tax in Georgia is 5% and Atlanta has a 1.5 city tax, what is the amount of sales tax on the lawnmower and what is the total purchase price? Step 1. Calculate the sales tax, which is equal to $488.95 times 0.065 to give a total of $31.78 in sales tax. Step 2. Compute the total purchase price, which equals $488.95 plus $31.78 plus 25 plus 15 to equal $560.73. Remember, there's no sales tax on packing, shipping, handling, or setup charges for merchandise purchases. These charges should be added after the sales tax has been computed. From time to time, merchants and customers may want to know the actual selling price of an item when the total purchase price, including sales tax, is known. Here are the steps to calculating selling price. Step 1. Calculate the selling price of an item, which is equal to total purchase price divided by 100% plus the sales tax rate. Step 2. Determine the amount of sales tax by subtracting the selling price from the total purchase price, using sales tax being equal to total purchase price minus selling price. Here's an example. Ari Daniels bought a television set at Costco for a total purchase price of $477. If his state has a 6% sales tax, what was the actual selling price of the TV and the amount of sales tax? Step 1. Calculate the selling price, which is equal to $477 divided by 100% plus 6%, which is equal to $450. Step 2. Calculate the sales tax, which equals $477 minus $450 for a total of $27 in sales tax. When both sales and excise taxes are imposed on merchandise at the retail level, the excise taxes are not included in the selling price when sales tax is computed. Each tax should be calculated independently on the actual selling price. Don't tax the tax. The excise tax is not included in the selling price when the sales tax is computed. Each tax should be calculated separately on the actual selling price. Here are the steps to calculating an excise tax. Step 1. When expressed as a percent, multiply the selling price of the item by the excise tax rate. Excise tax equals selling price times excise tax rate. When expressed as a fixed amount per unit, multiply the number of units by the excise tax per unit, where excise tax equals selling price times excise tax rate. Step 2. Calculate the total purchase price by adding the selling price plus the sales tax plus excise tax, where total purchase price equals selling price plus sales tax plus excise tax. Here's an example. The round-trip airfare from Miami to New York is $379. If the federal excise tax on airline travel is 10% and the Florida state sales tax is 6%, what's the amount of each tax and the total purchase price of the ticket? Step 1. Calculate each tax. Sales tax equals $379 times 0.06 equals $22.74, whereas the excise tax equals $379 times 0.10, which equals $37.90. Step 2. Calculate the total purchase price, which equals $379 plus $22.74 plus $37.90 for a total purchase price of $439.64. Ad valorem tax means a tax based on the assessed value of a property. The term property tax is used interchangeably with the term ad valorem tax. Property taxes are assessed and collected at the county level as the primary source of revenue for counties, municipalities, school districts, and special taxing districts. Real estate or real property is defined as land, buildings, and all other permanent improvements situated thereon. Real estate is broadly classified based on land use and includes single-family and multifamily residential, condominiums, townhouses, and mobile homes, vacant residential and unimproved acreage, commercial and industrial land and improvements, and agriculture. Personal property is divided into two categories for ad valorem tax purposes. Tangible personal property, such as business fixtures, supplies, and equipment and machinery for shops, plants, and farms. Household goods, exempt from property tax in most states, such as apparel, furniture, appliances, and other items usually found in the home. The value of property for tax purposes is known as the assessed value. In some states, assessed value of property is a specified percentage of the fair market value, while in other states it is fixed by law at 100%. Typical factors considered in determining the fair market value of a piece of property are location, size, cost, replacement value, condition, and income derived from its use. The assessed value is determined each year by the tax assessor or property appraiser. Most states allow specific discounts for early payment of the tax and have serious penalties for delinquency. The Department of Revenue in each state has the responsibility of ensuring that all properties are assessed and that taxes are collected in accordance with the law. The property tax due is computed by applying the tax rates established by the taxing authorities in that area to the assessed value of the property. Our formula multiplies the assessed value by the tax rate, as you see here. Property tax rates may be expressed as a decimal or percent of the assessed value, per $100 of assessed value, per $1,000 of assessed value, or mills. Here are the steps to calculating property tax. Step 1. Convert the tax rate percent to a decimal by moving the decimal point 2 places to the left. Step 2. Multiply the assessed value by the tax rate as a decimal, where property tax equals assessed value times tax rate. Here's an example. Calculate the tax due on a house with an assessed value of $250,000. The tax rate is 7.88% of the assessed value. Step 1. Convert the tax rate to decimal form, where 7.88% equals 0.0788. Step 2. Solve for the property tax, where property tax equals $250,000 times 0.0788, which equals $19,700. Mills means 1/1000th of a dollar. For example, 0.0035 cents is equal to 35 mills. Here are the steps to calculating property tax using mills. Step 1. Divide the assessed value by $100 to determine the number of $100 the assessed value contains. Number of $100 equals assessed value divided by 100. Step 2. Calculate the property tax by multiplying the number of $100 by the tax per $100, where property tax equals the number of $100 times the tax per $100. Here's an example. Calculate the tax due on a house with an assessed value of $250,000. The tax rate is $7.88 per $100 of assessed value. Calculate the number of 100s, which is equal to 250,000 divided by 100, which is 2,500. Step 2. Solve for the property tax, which is equal to 2,500 times 7.88, which equals $19,700 in property tax. Typical examples include public schools, law enforcement, fire protection, hospitals, public parks and recreation, roads and highways, and sanitation services. The tax rate necessary to meet the budgetary demands is determined by two factors. First, the total taxes required, and second, the total assessed value of property in the taxing unit. The tax rate is computed by the following formula. Tax rate per dollar equals total taxes required divided by total assessed property value. As before, the tax rate may be expressed as a percent per 100 of assessed value, per 1,000 of assessed value, or in mils. Here are the steps to computing property tax rates. Step 1. Calculate the tax rate per dollar of assessed property value by dividing the total taxes required by the total assessed property value. Round your answer to 10 thousandths, 4 decimal places. Step 2. Convert the tax rate per dollar. To percent, move the decimal point 2 places to the right and add a percent sign. To tax rate per $100, multiply by 100. To tax rate per $1,000, multiply by 1,000. To mils, divide by 0.001. When calculating tax rate per dollar, remember to round your answer to 10 thousandths, 4 decimal places, and always round up even if the next digit is less than 5. Here's an example. The budget planners for the town of Canmore have determined that $5.7 million is needed to provide all government services for next year. The total assessed property value in Canmore is $68 million. Step 1. Calculate the tax rate per dollar. Tax rate per dollar equals 5.7 million divided by 68 million to equal 0.0838235 or 0.0839 or 0.0839 cents. Step 2. Convert the tax rate per dollar. Tax rate per $100 is 0.0839 times 100 or $8.39. The tax rate as mils is 0.0839 over 0.001, which equals 83.9 mils. Income tax is a pay-as-you-go tax. The tax is paid as you earn or receive income throughout the year. Payment is accomplished through income tax withholdings made by employers on wages and salaries paid to employees, and through quarterly estimated tax payments made by people earning substantial income other than wages and salaries, such as interest income and business profits. For those individuals subject to personal income tax, a tax return must be filed by the appropriate IRS form before midnight on April 15th annually. The tax return pertains to income earned during the previous calendar year. As the income tax filing deadline approaches, taxpayers must begin the preparation of their tax returns. Although tax preparation services are available to help with this annual task, you still have to keep and organize the records necessary for the return. Keep in mind that even if someone else prepares your return, you're ultimately responsible for its accuracy. Taxable income is the amount of income to which tax rates are applied in order to calculate the amount of tax owed for the year. Here are the steps to calculating taxable income for individuals. Step 1. Determine total income by adding all sources of taxable income. Step 2. Calculate adjusted gross income by subtracting the sum of all adjustments to income from total income. Step 3. Subtract the sum of the itemized deductions or the standard deduction, whichever is larger, from the adjusted gross income. Step 4. If none of the conditions for high income returns apply, multiply $3,950 by the total number of exemptions claimed and subtract it from the outcome of Step 3. Here's an important note for high-income returns. If income is greater than or equal to these amounts, see www.irs.gov to find exemption amounts. Once tax liability has been determined, we must consider the final three items in income tax preparation: tax credits, other taxes, and payments. The following formula is used to complete the tax preparation process. Note, when the result is a positive number, it's the amount of tax owed. When the result is a negative number, it indicates a tax overpayment by that amount. When an overpayment occurs, the taxpayer has the option of receiving a refund or applying the amount of the overpayment to the next year's estimated tax. Tax credits are dollar-for-dollar subtractions from tax liability. A tax credit of $1 saves a full dollar in taxes, whereas a tax deduction of $1 results in less than $1 of savings. The amount depends on the tax rate. Some examples are credits for child and dependent care expenses, credits for elderly or disabled, and foreign tax credits. In addition to the tax liability from the tax table or tax computation worksheet, other taxes may also be due. These taxes are added to the tax liability. Some examples would be self-employment taxes and Social Security and Medicare taxes on tip income. Payment calculation involves subtracting payments such as employees' federal income tax withheld by employers, estimated tax payments made quarterly, excess Social Security and Medicare paid, and the earned income credit. Here are the steps to calculating a tax refund or amount owed. Step 1. Subtract total credits from the tax liability. Step 2. Add the total of other taxes to the tax liability to get total tax. Step 3. If total payments are greater than total tax, a refund of the difference is due. If total payments are less than total tax, the difference is the tax owed. Here's an example. After preparing her taxes for last year, Emily James determined that she had a tax liability of $5,326 and owed other taxes of $575. Emily was entitled to a credit for elderly care of $1,412. If her employer withheld $510 from her paycheck each month, is Emily entitled to a refund or does she owe additional taxes? How much? Steps 1 and 2. Calculate the total tax owed, which is equal in this case to $500,326 minus $1,412 plus $575 for a total of $4,489. Step 3. Calculate the total payments compared to taxes owed, where total payments equal $510 times 12, which equals $6,120. So, her refund will be $6,120 minus $4,489 for a total of $1,631. The IRS uses a corporate tax rate schedule to calculate the amount of income tax due from corporations. Here are the steps to calculating corporate income tax. Step 1. Using the corporate tax rate schedule, find the range containing the taxable income of the corporation. Step 2. Subtract the lower number of the range from taxable income. Step 3. Multiply the result by Step 2 by the tax rate listed for that range. Step 4. Calculate the tax liability by adding the result from Step 3 to the dollar amount of tax indicated for that range. Step 5. Finally, calculate income after taxes by subtracting the tax liability from the net income before taxes.